Hey everybody, this is John. Let's dive in here. I want to take a look at Facebook. So in the premium video, I'm also taking a look at the internals. Be sure to take a look at that. Very surprising readings in the internals today, and so just wanted to dive into that. So for Facebook, I do like Facebook here in terms of a bullish play. It's kind of held its own even when the markets sell off. From a weekly perspective, that's super bullish. From a daily perspective, this isn't bad. This last squeeze kind of petered out. And you can see right now there's not really a squeeze setting up or anything like that unless you drop down to the 195-minute chart. So we do have a nice squeeze. Because of the momentum that we got today, we recaptured this prior resistance. What should happen is that the momentum here should turn, and then it can kind of slingshot us up. And I don't have a lot of, I think we can get to about 175 or so. I mean, to me that makes sense, and it's pretty clean. So what I wanted to do is, for those of you that are newer, is just show you that there's a lot of different ways to kind of skin the cat in terms of how we could potentially do this. Meaning that, yeah, you could buy calls, but there's also other things that you could do. So let's take a look at that. All right, so here's Facebook. We added these positions when it was about $172 today, and so let's just kind of drill down here. So a couple things I want you to notice. Now this is it's overkill. You don't need to do this many positions on it. But I was doing this today as more of kind of a learning lesson, to showing you like, hey, there's a couple different ways to skin the cat based on your goals. So the easiest way, the plan here is like, all right, Facebook goes to 175. How do we make money from that? Well, we can buy deep in the money October monthly calls, 31 days out, $165 strike for $850. And if this goes up to 175, we should be able to sell these for about 10 bucks, okay, give or take. A little bit more than 10, depending on how much premium it holds. All right, so not a huge percentage winner, but not bad. It makes sense. It's easy to get attracted to the idea of options, like, oh, I want to buy it at 1 and sell it at 5. But you can make a living buying stuff at $850 and selling it at 10. So that's the easy way to do it. Now, a little bit more advanced technique, what I like with this, is a diagonal. So we're still buying a call 31 days out. And so why 31 days out, and why not like something that expires this week? Well, we don't know exactly when it's going to make its move to 175, right? It could be a slow process. It could pull back. So if we're doing something that it expires in 3 days, we have to be right away, okay? So that's really never good. I mean, you just have your timing. You have to know exactly what's going to happen next. And in the markets, it's very rare that you're going to know exactly what is going to happen next. In fact, you're never going to know exactly what's going to happen next, right? So by going out 31 days, what happens is we're minimizing premium decay, and we're giving ourselves a little bit longer to find out if it's going to work or not. So we're giving it a chance. The diagonal I like, because we still go 31 days out and buy a call, this time 167.5, but we sell the 175 that expires in 10 days. That's out of the money, with the idea that that could expire worthless. So in a perfect world, at the end of the next week, we're at 174.75. This expires worthless. We keep the money, and then we continue. We keep that money, and then we keep these. And then if you go down here, there's some other ways to do it. Now this is a little more probably a unique way to look at it, and I don't recommend it for a lot of people, but I like doing it. Hey, I think it's going to go to 175, so I think I'll sell the 175 call and the 175 put, because if we do rally up to 175 and stop there, both of these will expire worthless, and I'll make $4.27. Okay, so we can see that by doing this way, our profit potential is like 2 times what this is, just buying a call. But there's a lot of ifs there. It has to go to 175 and just stay there and do nothing, and we know that that's not, not necessarily what's going to happen. But the main point is that this is pure premium. There's a lot of premium here, and if we rally slowly, then this will work. If we rally really, really fast, then this could become a liability. Along the same lines, what I also did is said, well, I'm a little bit more bullish on this, so I just sold the 175 put by itself. Okay, so if we rally up to that level or keep going beyond it, this goes to 0, and I get to keep that money. Okay, butterflies. This is something where, again, I'm looking for this to go to 175 bucks. If it does, I'm essentially risking 50 cents to make $2. And, put spread, out of the money put, and an at the money put spread. So at the end of the day, I've got all these different things going on. I've got a theta positive position, and it gives me a lot of flexibility. Okay, now, do you need to do all of this stuff for every trade? Of course not. But it just kind of shows you that there's a lot of different ways to skin the cat. And hopefully that makes sense. So anyway, I'll be managing these in the room. You guys have a good night, and we'll see you at the next update.